Joining us right now, Chris Lowe, Chief Economist with FTN Financial, and Bill Hench, Royce and Associates Portfolio Manager. Barry Knapp right alongside us as well. All right, Chris, beginning with you, explain your thesis here. How is it that we can still come out ahead in light of Europe?
Well, look, the critical thing is global slowdown. And in fact, really, let's call it what it is, global recession. You have the BRICS slowing way down. You have Europe in recession. I think they'll muddle along politically, and that's critical to the thesis. As long as they do, the economy slows down, and that means less demand for raw materials. We're already seeing that reflected in commodity prices. And it's like a huge tax break here. Absolutely. If you look at 98, the last time there was a global recession that didn't include us, we lost exports. Exports took away about 1% from GDP over the next year in 98.
But can we afford to lose another 1% given that we're at 1.8, as Barry was pointing out?
Well, what happened was we got 1.5% added back from consumption because consumers are 70% of GDP, exports only 12%. It was lower gas prices, lower food prices, lower consumer product prices. And if you think about real income in the U.S. growing at 0.5 right now because inflation is, was about 2.5. If that comes down to 1 or 1.5, that triples the growth in real income.
Bill, can we really be that insulated? I mean, as a domestic economy, we can rely so much entirely on ourselves in spending because of lower commodity prices?
No, I don't think we could be insulated, but I think what we do is we get adjusted prices. So whether you're buying stocks or houses or property or land or commercial property, it's all been adjusted because of what has happened in the world.
Well, when you say everything, I mean, are you talking a deflation scenario then? I mean, we were talking commodities.
Well, we have commodities. You have, affordability for housing, much, much better than it's been in a long, long time. Even the automobile you drive, look at the price that you pay for what you're getting. You're getting assets now at what are reduced prices, and the same thing holds true in the stock market, and especially with smaller companies.
Question, Alan Greenspan and to a certain extent Bernanke as well, focuses on core CPI, right, which excludes food and energy, a lot of the stuff that you're actually saying is a benefit if prices go down. So how do you resolve the fact that inflation, therefore, is going to be lower, and if there's not enough inflation, in theory, that's suggesting there's not enough growth? I mean, I sort of feel like muddling along somehow just means we muddle along. It's hard to get excited about buying assets.
We can muddle along, but in the long term, what are you trying to do? You're trying to get assets at the best price you possibly can. So when you do have that recovery, you take advantage of it, right? You don't want to. When would you rather have bought your house, back in 06, 07, or today?
So we may have to be patient, though.
Of course you have to be patient. Yeah.
But I mean, like 5 or 10 years patient.
Well, I don't know about 5 or 10 years.
So that's when I come back to that Japan scenario. Barry Knapp, what do you make of all this?
Well, look, in a credit-impaired world, typically what happens is you get hit by an external shock. So energy, and then you have a 1 to 2 quarter hit from that, and then you go back to trend. You don't get the growth back. So I agree that energy prices have been pretty interesting in their effect on consumer behavior during the recovery. Crude rebounded sharply in the third quarter of 09. We had less than 1% real personal consumption expenditures in the fourth quarter. Last year, crude prices ran up in the first quarter, less than 1% real PCE in the second. That's happening again this year. So I agree in the third quarter, we will bounce back. That's actually part of my thesis that we get a rally in the fall, is we have better back-to-school sales because energy prices have come down, but expectations have to be reset. Now, however, don't believe that growth slowdown has been played through the equity market. At 1320, the equity market is pricing in 8% one-year forward earnings growth, which is way too high. With global growth converging towards U.S. growth, we're probably looking at more like 4.
Wait a second, though. Let me ask you about that. If global growth is converging towards U.S. growth, might the U.S. look so much more spectacular than the rest of the world on a comparative basis? And if you're an international investor, you're going to want to be here? I mean, if you're a domestic investor, and we've had guest after guest on the show say, listen, be in the USA, that's the place to be right now. Might not you not see money flock?
That's exactly what's been happening. The dollar has risen, and that's part and parcel of that. However, international investors don't set marginal prices in the U.S. If anything, they're a pretty good contraindicator. When they come rushing in is generally when the market's at a bit of a peak.
Are
So
they
I don't
rushing
find
in
a lot
right
of
now? I
comfort.
mean, when you look at those metrics, do you get the sense that
the capital's coming in for sure. But the thing is, it's not necessarily coming into stocks. A lot of it's coming into bonds. I think you're right, and that we do see further selling before the market finds a bottom for just that reason. So much of earnings growth comes from overseas, and you're losing that. But at the same time, companies will refocus where they invest as well. And I think, barring fiscal cliff issues, a lot of that investment
So do you buy right
here
here
in the second half.
do you buy right here?
Not right here.
Not right here.
But
You wait
this
for it to go
summer,
lower.
Yeah.
This summer, what do you
You
think?
take advantage of the volatility. You're going to have these days where everything seems awful, and you take advantage of that. You're getting 2-3% down days, and you can take advantage.
Okay, and I know Barry thinks it's going lower from here too. So sort of sit tight, wait, look for your buying opportunity.
Right, but don't wait too long, right?
Don't wait too long, right? All right, Chris Lowe with FTN Financial, Bill Hench with Royce and Associates. Barry's sticking with us.